She locked the restaurant doors in March of 2020 and did not reopen for 11 weeks. 41 employees went home, the walk-in cooler full of inventory spoiled. She had spent 14 years building the place, and she was not panicking because she had bought business interruption insurance for exactly this. A government order shuts you down. The policy replaces your lost income. She filed the claim the first week, but denial arrived in 9 days. It cited a single clause she did not know was in her policy. The clause was 4 lines long. It erased everything. Business interruption coverage is part of most commercial property policies. The logic is straightforward. If your business suffers physical damage, a fire, a storm, a burst pipe, you lose income while you rebuild, and the policy replaces it so the business survives the gap. For decades, it was one of the most valuable protections a small business could buy. She had paid for it every year and even paid extra for a broader version a broker recommended. She believed she had bought certainty. What she had bought was a promise with a hidden exception. The clause that defeated her was a virus exclusion. It stated that the policy did not cover loss or damage caused by any virus, bacterium, or other microorganism capable of causing disease. 4 lines. Plain enough to read, easy enough to skip. Most policyholders never noticed it because, until a pandemic, it never mattered. It sat in the policy for years doing nothing, like a fuse waiting for current. When the virus arrived, the fuse blew, and the entire coverage went dark in a single sentence. She did not believe it could be that simple, so she read the rest of the policy, line by line, for the first time in 14 years. The coverage language was generous, the exclusion was specific. And then she found the second wall. Most business interruption coverage requires direct physical loss or damage to the property to trigger at all. A virus, the insurers argued, does not physically damage a building, so even without the exclusion, the claim would face a second denial built on the words physical damage. 2 barriers stacked. To understand why that exclusion was there, go back to 2003. That year, the SARS outbreak swept through parts of Asia and Canada. Hotels emptied, restaurants closed. A wave of business interruption claims followed, and insurers paid out on policies that had no virus exclusion because no one had thought to write one. The industry learned an expensive lesson. A contagious disease could trigger losses across thousands of businesses at once from a single event. So the industry decided it would never be caught that way again. In 2006, an industry organization that drafts standard policy language filed a new exclusion for viruses and bacteria with state regulators. The filing memo was candid. It said the exclusion addressed concern that the spread of disease could result in claims and that there had been recent attention to losses from disease-causing agents. In other words, the industry told regulators, in writing, that this clause was designed to keep pandemics off their books. Regulators approved it. It spread into commercial policies across the country. So when the pandemic came, the trap was 14 years old and waiting. Thousands of businesses filed claims. Insurers denied them in waves, citing the virus exclusion and the physical damage requirement. Litigation exploded. Restaurants, theaters, salons, and gyms sued. The courts, for the most part, sided with the insurers, holding that a virus does not cause direct physical loss, and that where a virus exclusion existed, it plainly applied. The clause written in private decided the outcome in public. There were cracks in the wall, and they mattered to a few. Some businesses had policies with no virus exclusion at all, often older or specialized contracts. A handful of courts accepted that the virus on surfaces constituted a physical condition affecting the property. Some insurers, facing bad publicity or weak language, settled rather than litigate. But these were exceptions. For the overwhelming majority, with a virus exclusion and a standard policy, the claim was dead on filing. Her policy was standard. Hers was dead. What saved some businesses was not insurance. It was government. Emergency relief programs, forgivable loans, and grants kept many doors from closing for good. She survived on one of those loans, and on credit cards she is still paying down. Her insurance, the product she had bought specifically for a forced shutdown, contributed nothing. She had paid premiums for 14 years toward the exact scenario the policy was advertised to cover, and the one time it arrived, the policy had been engineered in advance to pay zero. The aftermath reshaped the market. Insurers tightened virus and communicable disease exclusions even further, making sure no ambiguity remained. New standalone pandemic products appeared, expensive and limited. Lawmakers floated a federal pandemic insurance backstop, the way terrorism risk is backstopped, but no broad program became law. The lesson the industry took from the pandemic was not to cover the next one. It was to write the exclusions more clearly so the next denial would be even faster. The wall did not come down. It got taller. What this means for any business owner reading a commercial policy. Do not assume business interruption coverage means what it sounds like. Find the exclusions page and read every line. Look for virus, bacteria, communicable disease, and pollution exclusions. Look for the words direct physical loss or damage because that phrase is the trigger, and its absence in your loss can void everything. If your business depends on staying open, ask your broker in writing what is excluded. The coverage is defined by what it removes, not by what the brochure promises. She reopened. 41 jobs came back, slowly. The 14 years of premium she paid toward a shutdown she never got covered for, she will not see returned. The clause that erased her claim was not hidden in bad faith. It was filed openly, approved by regulators, and printed in her policy where she could have read it. That is the harder truth. The exclusion was not a trick. It was a decision made in 2006 about who would carry the cost of the next pandemic. The answer, written into 4 quiet lines, was always going to be her. If this one stayed with you, episode 25, the clause that let insurers deny nearly every Hurricane Katrina claim runs on the same logic. One sentence, written years before the disaster, deciding who pays. It is on this channel.